What's going on, everybody? My name's Josh and this is Beers with an Economist. Today we're going to be talking about what in the world has happened to house prices. Have you been looking at house prices and wondering, who can afford this? Well, today that's what we're going to talk about. And I'm sorry, real estate bros, it's not about just people wanting those bigger, better houses. It has everything to do with interest rates. That's what we're going to talk about today over beers. First of all, if you think that house prices have been going crazy over the last couple of years, you're not wrong. So if we look at the data in early 2019, so long before COVID was a factor, if we start, the average house price in the United States was about $375,000, $375,500 to be specific. Now, if we look at that same house price, average US house price in the last quarter, so quarter two of 2022, it was $525,000. That is a 40% increase in home prices in just under 3 years. Now you may be thinking, well, like everything's gone up in those 3 years, haven't they? No, household incomes have actually slightly dropped over that same period of time. So house prices have literally gone crazy. So what is the cause? Now, if you talk to a real estate agent, right, or some real estate mogul type person, they're just gonna be like, well, it's just, fundamentals. It's just demand, right? It's COVID. People want bigger houses. They want home offices. They want more space. And that's been driving people to buy more homes. But there's some problems with that logic, isn't there? Right? Couple things. One, COVID definitely influenced the preferences of individuals when it comes to the type of dwelling they want to live in, for sure. But the problem is that, over that time period, the population of the United States hasn't increased much at all. So, and at the same time, we have another big problem when it comes to demand. You see, if you go back and you look at any Econ 101 textbook, it'll tell you that demand is made up of both the willingness to pay, that's the part the real estate agents are focused on. People want better houses, right? But also, there's this other little nagging factor everybody wants to forget, which is the ability to pay. You have to be able to afford what it is that you want for demand to be there. Now, again, I've already mentioned that family or household incomes over that same period of time have actually gone down. So where is this extra affordability coming from? Well, it actually did come from somewhere, but it's the place that most people don't ever think about when it comes to houses, and that is interest rates. What do I mean by that? Well, folks, the average American is not actually buying a house, are they? What they're doing is they're buying a mortgage. And that's because most houses are, again, hundreds of thousands of dollars, and your average American household doesn't have the kind of savings necessary to go out and pay cash for a house. What they have to do is they have to get a loan for that house. That loan is called a mortgage, and they have to pay an interest rate to service that loan that we call a mortgage rate. So what does that have to do with house prices surging during 2021 in particular, right? Well, let's think about what happened to mortgage rates over that period of time, right? So in early 2019, so again, kind of starting a year before COVID, so we're not worried about that influence. About the average U.S. mortgage rate was somewhere around 4.37%. Okay, and that's actually pretty normal for a U.S. mortgage rate over the past 15 years or so. Now, what is that? All right, we're gonna have to cut.
If you drank more beer, this would go a lot quicker.
Over that period of time, what happened to mortgage rates? Well, in early 2019, a year before the pandemic started, the average U.S. mortgage rate was 4.37%, which is pretty normal mortgage rate for the past 10 or 15 years or so. Now, how did that change over the course of the next couple of years? Well, by quarter three of 2021, so about this time last year, the average mortgage rate was 2.68%, right? So that's a nearly 2-point drop in the mortgage rate. Now, you may be thinking to yourself, well, that can't be that big of a deal, right? It's just a couple of percentage points. But that would be ignoring the power of compound interest in loans, because these are very long-term loans, right? Mortgages are typically 30-year loans for most people, and they're mortgaging hundreds of thousands of dollars over a very long time, and that principal is compounding over all those periods. So a swing in interest rates like that can actually make a huge difference in affordability. So let's crunch some numbers, make it real, right? Okay, so for example, if we just kind of assume that the average buyer is putting 20% down on their house, and that again, that the affordability of homes, so that $375,000 home in 2019, that's about what the average consumer could afford at that time, which makes sense because that's what homes were selling for, right? So they're mortgaging about a little over $300,000 at a 4.37% mortgage rate, which equates to just under a $1,500 a month mortgage payment. $1,498.97 to be precise. Now, if we think about, let's just take as given for a moment, we'll just assume that the budget of the average American household hasn't changed much over the past few years. And again, as I've already mentioned a couple times, the household income data is remained basically flat, maybe even dropped a tad. So this is a pretty good assumption. So, and that the average American household can afford about a $1,500 mortgage in their monthly budget. Now, if we do that and we fast forward to quarter 3 of last year, 2021, so a year ago, with that lower interest rate of 2.68%, what could this same family afford house-wise? Well, just that small drop in the mortgage rate allowed that same family to afford a $463,000 house. $463,126 to be precise. So that is a 23% increase in the amount of house that the average American family could afford just from that small drop in interest rate. Let me say that again, right? So $375,000 to $463,000, that's nearly $100,000 more house. Nothing has changed about their budget. The only thing that's changed is the mortgage rate. What has happened since then? So this kind of tends to explain why the housing prices have been surging, right? So people could afford more. And so you have people that can afford more chasing after the same homes. That's what's driving up the prices. So what's happened in the meantime here? And why am I a little, we'll say, bearish on the real estate market moving forward? Well, interest rates haven't stayed low, have they? I don't know if you guys have been paying attention to this, but you might have seen something in the news recently about a little thing that we're having going on here in the US called inflation, right? And inflation is at an unprecedented high right now in the United States. Now, the Federal Reserve, that dropped interest rates in order to combat the recession caused by COVID, which was the catalyst for dropping those interest rates in the first place, they have since started raising those rates in order to combat the inflation that we're currently experiencing. So what has happened to interest rates over that time since the Fed's been fighting inflation, right? Well, in quarter 2 of 2022, that is this previous quarter that the data came out, the average mortgage rate was 5.27%. Folks, that's a nearly doubling of the mortgage rate. Now, if you could follow me when I discussed how the affordability of the house increased dramatically as the rate dropped by less than half, what do you think is going to happen to the affordability for the average American household when the interest rate nearly doubles? Oh, it's bad news, folks. So that same family, so again, we'll start from the top. In 2019, the average family was buying a $375,000 house. approximately. That same family, based on interest rates dropping, by last year could afford a $463,000 house. Now, unfortunately, that same family today, with current mortgage rates, can only afford a $339,000 house, which is a 10% drop from what they could afford in 2019. Let me put that one more way for you to really put that in perspective. The average American can afford a $130,000 less house than they could afford 1 year ago. But what has happened to house prices over that same period of time? They haven't dropped, have they? So last year, the average American home was selling for $473,000. Today, the average home is selling for $525,000, a $50,000 increase over the same period of time that the average American can afford a $130,000 less house. To a certain extent, house prices continue to go up because inventories in 2021 were at historic lows, right? So essentially what happened was that the average home price didn't quite keep up with the affordability at first. So that is, the average American could afford more house faster than the house prices rose, again, because real estate pros don't pay attention to interest rates. But that caused everyone to be able to afford these houses. It cleaned out the inventory in real estate markets pretty quickly, and inventory hit historic lows last year. Now, why do I not think that that is going to keep prices high in 2022? Because that stat that I just mentioned, historically low inventory in 2021, has flipped on its head in 2022. Currently, we are experiencing the highest level of real estate inventory since 2008. Hold up, everybody. Let's pour one out for 2008. I'm just kidding, folks. I don't waste beer on the show. And I don't think I need to remind you guys what was going on in the real estate market in 2008, do I? And you might think, well, that's just one data point. Well, actually, this is the highest real estate inventories have been since 2008 and only two other time periods, 1980 and 1981, which are known for being times when we had double-digit prime rates, which means double-digit mortgage rates. So, yeah, this is a big deal. All right, so in summary, folks, what have we learned today? Number one, and primarily number one, and if you're a real estate person listening to this, please listen to this point. People don't buy houses. The majority of people buy mortgages, right? And mortgages and their affordability are primarily influenced by interest rates. And what we saw in 2021 was an insane swing in interest rates. So interest rates nearly halved at one point, and then in less than a year, nearly doubled back to more than a point higher than they were in 2019. And what that did was it caused the average American to be able to afford $100,000 more house and then $130,000 less house. This is a wild swing in what the average American can afford because of a wild swing in interest rates. And that is what happened. And so where do we go from here? Because house prices haven't dropped yet, have they? The average American home is selling for $525,000, which is a full nearly $200,000 more than what the average American family can afford right now. That's not sustainable, folks. That can't last. So what's going to happen? House prices are going to drop. That's it. They have to. You can't sustain this incongruency between what people can afford and what people are trying to sell their houses for, right? It's just not going to happen. So house prices are going to come down, right? And if you don't believe that I'm telling you the truth, the writing is already on the wall, folks. Inventories are accumulating faster than they've accumulated before. We have inventory accumulation in the housing market equivalent to 2008. Right? That is where we're at. And that is a great indicator that house prices have to come down. So if you are in the market for a house, wait. And then wait some more, because those prices are coming down. Now, unfortunately, if you were in the market to sell a home, I'm sorry, you are going to have to drop the price. Now, this is the problem, is that nobody wants to drop that price, right? They're like, how could my home be worth less than it was just a few months ago? Again, it's those damn interest rates that are going to bite you in the butt. The average American just cannot afford the same level of home that they could even a year ago. So, I know it hurts, but just go ahead and drop the price of that house. And if you drop it now, you're going to beat the other people to dropping it, and you might actually make most of your money back. If you wait, you're going to be in the mix of everybody else dropping their price when they realize that the house just ain't moving. So, I realize this is bad news, but as the real estate bros love to say, it's just market fundamentals, folks. Till next time.